In today's video, traders, we're going to be talking a little bit about risk management, talking about risk per trade, position sizing, and how much of a lot size you should use on your particular trading account. I'm going to go through some tips for you, and let's go ahead and get into the video right now. So welcome back, traders. If this is your first time here, my name is Nick. I make all sorts of trading educational content as well as share research and data about the currency market with people here on the YouTube channel. So thanks so much for joining me. Let's go ahead and talk a little bit about today's topic, which is going to be risk per trade. Let's talk about position sizing. Let's talk about what kind of lot size should you use on your account. Now, this is something that needs to be addressed because I find this to be an extremely common problem. Now, somewhere in your broker, a lot of times you'll see something like this. You'll see them giving the opportunity for you to use something as crazy as 1,000 to 1 lot size, or leverage, or 500 to 1 leverage, right? They give you these massive amounts of leverage. Now, here's the thing. People look at this and they say, oh, that's amazing, right? They're very happy about having a lot of leverage. But I say that this is extremely dangerous. Now, is it bad to have high leverage? No, not necessarily. The problem is a lot of people don't know how to use leverage in an intelligent way, and they use really big position sizes relative to their account. Today's video is going to be all about risk per trade, and we're going to be talking about drawdown a little bit. We're going to be talking about risk management and why it's important to keep your position size the right amount on your account. So make sure you do stay tuned. Let's go ahead and continue on with this concept. So we're talking about risk per trade. The name of the game, if you've been watching my channel for a while, I scream about this all the time. I don't think I'll ever shut up about it because it's extremely important. Risk is everything when it comes to trading. It's not about how much money you can make. It's about keeping money in your account and protecting the capital you bring to the table. If you need to rewind that and listen to it, I do hope you will, because that's something that changed trading for me forever. When I realized that it's not about how much money you can make, but rather protecting the capital you have and being a risk manager rather than kind of a gambler, right? That changed everything for my trading. So let's go ahead and talk about, well, how can we actually figure out what a good risk per trade is? Well, if you have a $1,000 account, right? You need to think a little bit about these numbers that are going into it. A lot of people will take a look at a $1,000 account and they'll put something like a 1.00 lot size position, right? Well, here's the problem with this. Here's what my problem is. Here is what my frustration with this is if you're using a 1.00 lot on a trading account size of like $1,000, it only takes a couple losing trades to seriously impact your trading account. In fact, a lot of times people will do something as much as 10% risk per trade. This is the problem. This is the thing that I have a problem with, and is that in trading, technical analysis is not something that's perfect, right? It comes down to understanding technical analysis. What is technical analysis? Well, technical analysis is the process of looking at charts and coming up with a trade thesis or prediction for where price may be headed next based on historical movements, right? So technical analysis might give us some sort of clues, but at the end of the day, technical analysis is a game of probabilities, okay? So it's all about probabilities. And the thing is, if we're using a $1,000 account, and we're using 1.00 lots, we don't give a lot of room for error. And the problem with this is that error comes no matter how good your strategy is. Even if you have a 70% win rate or an 80% win rate or even a 90% win rate, there's gonna be a series of losers that come along, and you need to be prepared for this. If you're risking 10% per trade, look at this, guys. Let's say that you just have 4 or 5 losers in a row, right? Which can happen. The thing is, a lot of people are looking for some strategy. They think, that they're going to find a strategy that never loses 5 times in a row. And I can tell you that losing 5 times in a row is entirely possible and has happened to me multiple times in accounts that I've made money on. I'll say that again. I have accounts that have made money overall and taken 5 losers in a row just fine. It's not a problem to take losers. A lot of people who think they're newer to trading the markets, they think that they need to be winning all the time. That's not always the case. It's okay to take losers, but taking 10% losers on your account, that's huge. What this means is that we're going to be using $100 on this account, right? And if we lose $100 5 times, well, suddenly the account is 50% drawn down. It's 50% lost in it, right? Because we have now $500 in our account, right? Suddenly, our leverage has been drastically reduced. Suddenly, the account size has been drastically reduced, right? We've lost $500 in just 5 trades. And I'm telling you from experience that 5 losing trades in a row can totally happen, even if you have a 70% win rate, right? It's not out of the question because remember, technical analysis or trading in general, doesn't even matter if you're using technical analysis, it could be fundamental, whatever you're trading, right? If you take trades in the market, you have a probability of winning. You don't have a guarantee of winning. So if you don't have a guarantee of winning, it's not out of the question that we see something like this. 5 losing trades in a row. And if you're risking 10% on every single trade, right? Whether it's your stop loss or whether you have some sort of dynamic exit where you close out at 10% down, right? If you do this and it happens 5 times in a row, suddenly your account is cut in half. This is tremendously dangerous to trade your account like this because it means that suddenly you could be losing half your account. And here's the thing. If we want to take $500 and just to break even, how much percent do we have to get back? It's not 50%. We may have lost 50%, right, on the way down, but to get back to our starting balance, guys, what do we need? $500 to $1,000 equals plus 100%. What we've just done is created a situation where in order just to get back to break even, just to get back to our starting point, guys, we need to make 100% in profits. That's something that people, the best traders in the world shoot for, some people shoot for 20% per year. 20% per year. Warren Buffett consistently around 19 to 20% per year for like 40, 50 years. That's a tremendous track record. That's an amazing growth over time. But 100% just to get break even, well, you've pretty much killed the account because now you're going to have to gamble your way back. And just to get break even, you have to take tremendous amounts of risk in which you might risk blowing the account again, right? Because the problem is when we lose accounts really quickly because we're using big risk, that can kill accounts really quickly because suddenly you don't have any energy, right? Having money in your account is like having gas in your car. If you want to get further, you need to have a lot of gas in your car at all times, right? If you want to go on a long road trip, you can't just run out of gas in the first, day or so, right? You have to have gas ready and you have to have gas prepared. In trading, it's the same thing. We want to keep everything. Everything is about this number right here, our starting capital and protecting it. So the first thing I'm asking you to do is just to consider in your own trading. Look at what you're doing. Ask yourself, am I risking too much per trade? Because if so, you should probably consider looking a little bit more into risk management. Okay, so let's erase that and let's take a look at the concept again. Now let's talk about what maybe would be considered a little bit better of an approach. So we mentioned 10% per trade might be a little bit ridiculous, right? It might be a little bit dangerous to do 10% per trade. But what about something like 1%? Well, let's take a look at it. So let's say again, we take our theoretical $1,000 account, okay? And this time, let's say that we have 5 losers. Again, a very appropriate, very occurring thing. 5 losers in a row can happen to anybody and still they can be a good trader. I'll say that again. You can have 5 trades in a loss in a row and still be a good trader. It's about controlling your emotions and sticking to the plan, right? So let's say that we have minus 1% here, right? And we do that 5 times. We lose 1% 5 times. Well, now the account is down just 5%. That's not the end of the world. 5% on the account is not the end of the world, right? What is 5% of $1,000? Well, that would be $50. So we would have $950 in the account, right? So now we have $950. Well, guys, here's the thing. We're still in business here. Remember, trading is like a business. We're trading probabilities. We don't have any sort of guarantee. So we've prepared for the fact that this can happen, right? We've prepared that our technical analysis is never going to be perfect. We've prepared for this by saying, okay, if 5 trades go in loss in a row, that just brings us down $50. We're at $950. We can still recover from this. We have a ton of leverage still available to us. We have a ton of room to bring this back to $1,000 and even grow it from there. But what do we sacrifice here? This is where a lot of people don't like. This is the other side of the conversation that people don't want to hear. This is going to limit us from making huge amounts of money. If we're just risking 1%, let's say that we're going for 2%, and let's say, for example, that you have a couple winners and a couple losers. This is another theoretical. Let's say that we have 3 winners, and we're risking 1% to make 2%, right? And let's say that now we make 2% 3 times, and we lose 1% twice. Okay, so what does this mean? This means that we had a 3 out of 5 winners, right? And this would give us a net of 2, 4, 6 minus 2 would give you 4. So plus 4% on the account. And let's say that that happens in the course of maybe 2 weeks, or let's say you're doing a swing trade or whatever. Well, 2% on these trades would be fantastic. It would give you $1,040. We've grown the account on a stable amount, right? Are we doubling and tripling accounts in really quick times? No, but we are building consistency, and we're building over time something that could look like this, some sort of consistent model. We 2% here, we lose 1%. Very okay. It's okay to take losers. Embrace the losers. Don't fight them because they will happen, right? Embrace them and learn from them. 1% loss plus 2% minus 1% plus 2%, and we end with 4%. And that means that we made our account go from $1,000 into $1,040. Not bad at all. Over time, this number can get bigger, right? The percentage gain will stay the same, but the number can be bigger. Now, I'm not explaining that super well, but basically it's the power of compounding interest. Because now 2%, if we were to make 2% more of this number, it's not just $20, right? In fact, it would be more like, I'm terrible at math, but you can see it would be more than $20. Let's say it's like 22 or some number, right? Now it's slightly bigger. And over time, we scale the account. And this is not something that happens in 1 month. It's not something that happens in 2 months. It's something that takes over the course of many months and even years. That's how people scale accounts over time. I want to talk about this concept because, again, it's not about how much you make right here. It's about how you protect the starting capital or your principal when you come to the game, right? It's very important to play defense in your trading, not to focus so much on offense. Everybody wants to talk about, oh, I doubled my account really quickly, but that doesn't really kind of hold out well in the end because, again, those losing streaks will come. And if they wipe you out every single time they come, then you're never going to grow an account. You're going to continuously blow accounts. And the only way you're going to get to the point where you're consistently profitable is to get more realistic. Go for small gains and build them over time. That's what I do every single day. Well, people ask me all the time, well, Nick, why do you make videos? Why do you have other businesses if you're a trader? And they're accusing because they think that trading is like this, where you're making 20% per day and it's big bucks all the time. And the reality is that I've been growing accounts slowly over time. I'm not a millionaire. I'm not, super rich off of my trading, but I am growing consistently and I'm building profits over time and scaling accounts, right? So I have other sources of income to kind of build up the account along the way. Guys, thanks so much for taking the time to watch this video. I do hope that this was helpful. This is something I know that I needed to hear. And if you listened all the way through, thanks so much. Leave a comment down below and I'll definitely respond to you. Thanks again, and we'll catch you next time.